everyone, welcome to this explainer. Look, if you've been checking your crypto portfolio lately and feeling that familiar, uncomfortable knot in your stomach, I want you to just take a deep breath. Seriously, you are not alone in this. We are stepping into what is historically one of the most turbulent months for risk-based investments across the board. The charts are definitely flashing some warning signs, and if you're a newer investor, you absolutely need to pay attention. But listen, we are not here to panic. As your advisor, my goal today is to help you cut straight through all that noise, ignore the crazy sensationalist headlines, and hand you a clear, data-driven survival guide. We're going to deconstruct what the actual data is saying, look at exactly where the big money is flowing, and map out the critical levels you need to survive this week. So lock in, because we're about to separate the real signal from the noise and build up your confidence. Right off the bat, we are officially sitting in extreme fear territory. The crypto fear and greed index has absolutely plummeted down to a terrified 25. Now, if you're new to this specific metric, it's basically a thermometer for market emotion. It runs on a scale from 0 to 100, and it mixes together things like market volatility, social media sentiment, and overall momentum. So a 25, yeah, that means people are genuinely scared. For newer investors, seeing this extreme fear can be incredibly daunting, right? It feels like the sky is literally falling, and you can see everyday retail traders just panicking. But I really need you to understand a fundamental truth about these markets. When the crowd is fearful, the smart money is quietly, methodically positioning themselves for the next major move up. That 25 isn't a signal to run away. It's actually your signal to pay closer attention than ever. So to help you navigate all this chaos without losing your cool, we've broken this explainer down into 5 clear steps. We'll start by unpacking this market fear, then we'll look at the global macro shockwaves shaking things up, map out the current Bitcoin battlefield, debunk some of the big crypto fears floating around, and finally, we'll wrap up with your tactical playbook for the week. All right, let's jump right into part 1, the market fear factor, and how retail investors are reacting compared to smart money. We are seeing a massive contrast in behavior right now. On one side, you have the retail herd. These are often everyday, newer investors, and they are basically running for the exits. They're panicking, they're selling off positions based on scary news headlines, and they're letting pure, unfiltered emotion dictate their capital. But on the flip side, you have institutional smart money. These professional traders are actually using this extreme fear as a tool. The smart money playbook says you practice something called dollar cost averaging when times are tough. If you're new to the term dollar cost averaging, or DCA, just means you buy a set dollar amount of an asset at regular intervals, completely ignoring what the current price is. It smooths out all that crazy volatility, you buy into the fear, you hold steady through the choppy waters, and you wait patiently while the everyday trader sells at a loss. Moving right along to section 2, global macro shockwaves. We really have to look beyond the blockchain for this one. To really grasp why crypto is struggling to break out right now, we have to look at the global currency markets. And this brings us to a massive knowledge gap for a lot of people. Where is the money actually going? I mean, spot Bitcoin ETFs saw a net outflow of roughly $61.5 million leading into this week. Well, the answer lies over in Japan, with something called the yen carry trade unwind. So for years, these massive hedge funds borrowed incredibly cheap Japanese yen to buy riskier investments. And yes, that includes crypto. But recently, Japan's central bank stepped in, making the yen strengthen super rapidly. Because of this, those big hedge funds are suddenly facing what's called a margin call. You can think of a margin call like a bank suddenly banging on your door demanding a massive loan back right this second because your collateral dropped in value. To pay the bank back, these funds are literally being forced to dump their winning crypto positions just to cover their traditional currency debts. It creates this huge artificial selling pressure. It sucks money right out of crypto. And the crazy part is, it has absolutely nothing to do with Bitcoin's actual health or underlying fundamentals. And that economic tug-of-war is continuing right here in the US too. Crypto is basically being held hostage by conflicting data. On one hand, US jobs data just came in much weaker than expected. Historically speaking, weak jobs data pushes the Federal Reserve to become more dovish. That means they're more likely to lower interest rates to pump up the economy, which is usually fantastic news for crypto. But totally counterbalancing that, recent manufacturing output data just shot up to its highest level since 2022. That is a glaring signal that inflation might be roaring back. So the market is just sitting here, totally confused, not knowing whether to brace for an economic slowdown or a spike in inflation. And you know what happens when uncertainty rules the economy? Investments that swing wildly in price compared to the broader market, which is exactly what Bitcoin does, are always the very first to experience really violent, choppy price action. On top of all that, we can't ignore the geopolitics right now. particularly the rising tensions around the Strait of Hormuz. Because of the potential disruptions in that critical global waterway, oil prices had been fluctuating aggressively. Now, you might be wondering, why does the price of oil matter for my crypto portfolio? Well, think of high energy costs and high interest rates like a giant vacuum cleaner. They just suck all the spare cash right out of the everyday consumer's pocket. If normal people are paying way more at the gas pump and the grocery store, there is simply less money left over to invest in riskier assets like Bitcoin. It essentially acts as a hidden tax, keeping inflation sticky and suppressing the cheap liquidity that the whole cryptocurrency ecosystem desperately needs to fuel those big bull runs. Okay, section 3. Now that we understand the macro shockwaves, let's zoom in on the Bitcoin battlefield. The technical structure right now is pretty precarious. If you're a new investor, these are the exact levels you need to be watching. Right now, Bitcoin is fighting a tough battle, clinging to the $63,000 zone. This is serving as our absolute immediate support floor. We've tested this level multiple times recently, and thankfully, buyers keep stepping in to defend it. If Bitcoin can manage to absorb all this selling pressure and hold the line, our immediate targets overhead are $65,300, and then the next resistance cluster at $67,000. But a really quick warning for the beginners out there. Do not trust a sudden, massive price jump that happens on a weekend. Weekend trading volume is notoriously low, and those spikes are almost always fakeouts, designed by big players to trap amateur traders who buy in too late, only to watch the price violently drop back down on Monday morning. This is exactly why you absolutely must use stop losses. Those are the automatic triggers you set to sell your asset if it drops to a specific price, keeping you safe from those massive, unexpected wipeouts. We also need to talk about the Bitcoin miners because their pain is starting to reach a very critical threshold. Miners use these massive, highly expensive computer rigs to secure the whole network, and their hash price is essentially their profit margin. Well, looking at the latest data, almost 23% of mainstream mining rigs are currently running at a daily net loss. That number right there, $46,787, is vital. The most efficient mining models in the world still lead Bitcoin to hold above that exact price just to break even on their electricity bills. If prices were to dip much lower than that, we'd likely see a wave of miner capitulation. And what that means is miners would be literally forced to sell off their massive held Bitcoin reserves just to keep the lights on, which would dump a ton of intense new selling pressure right onto the market. But hey, while Bitcoin has been moving sideways and chopping people up, our scanners did find some isolated pockets of real strength. Take a look at Cardano. While the rest of the market was pretty much drowning in red, ADA surged 10%. Seeing this kind of extreme relative strength in a generally weak market tells us one of two things. Either huge investors are quietly accumulating it, or we're seeing a short squeeze. A short squeeze is when traders who bet the price would go down are suddenly forced to buy back their positions at a loss, which drives the price up incredibly fast. But the data here suggests this is actual spot buying, meaning real human beings are buying the actual asset to hold on to rather than just trading synthetic paper contracts. It's a perfect example of why you always have to look beneath the surface. All right, moving into section 4, debunking crypto FUD. Let's separate the myths from reality. So there was a massive community panic this week, centering around an exploit with the Coldcard hardware wallet. Let me be unequivocally clear about this. The market's reaction to this was completely, entirely overblown. The exploit in question actually requires highly sophisticated physical access to the device itself. So for the average crypto holder sitting at home, this scary headline is largely irrelevant. The price drop we saw off the back of this was just large investors, the whales, using a sensationalized news story to trigger retail stop losses and scoop up some cheap liquidity. But while this specific issue was totally overblown, this is actually the perfect moment to remind you that security is your absolute #1 job as a new investor. In crypto, you are your own bank. There is no 1-800 customer service number to call if you mess up. So let's talk about the most common digital wallet mistakes that completely wipe out new investors. The single biggest error? Storing your secret seed phrase digitally. Never, under any circumstances, type your seed phrase into Apple Notes, Evernote, or an email draft. Do not take a photo of your password with your smartphone. The very second that phrase is digitized on an internet-connected device, it can be compromised by malware. Another massive trap is phishing links, especially in Discord or Telegram channels. Scammers will literally pose as customer support, send you a link to authenticate your wallet, and the second you connect your wallet and sign a transaction you don't understand, boom, they drain your account instantly. So here is your non-negotiable 3-point checklist for protecting your personal investment accounts. Step 1, always use a reputable hardware wallet to store the vast majority of your funds off-LAN. Step 2, write your seed phrase down on physical paper, or better yet, stamp it into metal and lock it in a fireproof safe. Never type it on a keyboard connected to the internet, period. Step 3, always double check the first 4 and last 4 characters of any wallet address before you ever hit send on a transaction. It literally takes 2 extra seconds and it saves you from losing everything. If you master these basics, you instantly eliminate 99% of the risks that completely wipe out beginners. Which brings us to a really fantastic question we've seen floating around everywhere lately. With ETF outflows and Google search trends for crypto hitting multi-year lows, is retail interest completely dead? The short answer, yeah. The everyday public is currently fast asleep. But listen to me closely. This is a classic contrarian signal. When everyone else is bored, scared, or entirely disinterested, historically that is the exact time the smart money is heavily building their positions. The fact that the mainstream public has lost interest while major financial institutions continue building out massive infrastructure behind the scenes, that is exactly the kind of long-term bullish divergence you want to see if you are investing for the future. Finally, Section 5, your weekly trade strategy. Let's distill all this down into your marching orders. First things first, let's look at the history of August. Over the last 13 years, Bitcoin has closed the month of August in the red exactly 9 times. It has an average historical drawdown of roughly 4.3%. You just cannot ignore this reality. So as a newer investor, hear this loud and clear. This is absolutely not the month to take massive risks, use aggressive leverage, or try to double your portfolio overnight. August is strictly a capital preservation month. Your primary focus right now should be entirely on defense. And remember, preserving your capital isn't just about avoiding bad trades. It means rigorously adhering to that security checklist we just discussed so you don't lose your hard-earned money to a completely preventable mistake. So, what is your exact playbook for this week? Number 1, you need to monitor that $63,000 support level incredibly closely. If we see a daily close below that price, the short-term trend is broken and we are likely heading lower. Number 2, watch the institutional ETF money flows, specifically on Tuesday and Wednesday. If we see net positive inflows of over $50 million, that's your signal that big institutions are actively buying the dip. And number 3, keep your eyes glued to the US dollar index on the macro calendar. If the US dollar begins to finally show some real signs of weakness, that is going to act as the starter pistol for the next big leg up in the crypto markets, because a weaker dollar makes alternative assets like Bitcoin so much more attractive. Well, that wraps up this week's comprehensive market breakdown. But before we go, I want to leave you with one final thought. This turbulent, sideways chop we are seeing in August, it is explicitly designed to shake out weak hands and transfer wealth from the impatient directly to the patient. You have the data now, you understand the global economy, and you know exactly how to secure your assets. So the ultimate question is, are you going to panic with the herd and let emotion dictate your capital? Or will you stick to your security systems, manage your risk, and strategize methodically, just like the smart money? The choice is entirely yours. Stay sharp, stay safe out there, and I will see you in the next explainer.